What is going on, Future Focus team? Back at it. My name is George, and we talk about finance and investing in this channel. I got Matthew with me from Iwakuni, Japan, and I got Jonathan here from Queens, New York. Myself, I'm in Okinawa, Japan right now. Today, we're going to talk about taxes, specifically when it relates to investing in the stock market. This kind of applies to sort of like Bitcoin as well. But the reason we're going to talk about it is because, it's coming. Tax season is fastly approaching. And we got to file everything that we made throughout this year. I know a lot of us have made some significant gains. And a lot of people, it's like the first time they've ever been investing. So, what better time to talk about this topic than today? So without further ado, we're going to start with some basic questions that I've been getting. And I'll just answer the questions as we go through them. So the first question I've been getting a lot is, will I pay taxes if I don't sell my stocks? So this is where we talk about realized versus unrealized gains. So no, if you do not sell the stock, you will not be taxed on it because you haven't realized that gain. So you could be up 400%, and as long as you don't sell, you could leave that in there for years and years and you won't be taxed on it on a yearly basis. Whenever you go to pull out that money, that's when you'll be taxed on it. All right, the next question I've heard is, will I pay taxes if I sold for a gain but did not withdraw the money from my brokerage account? And the answer to this question is yes. Just because you did not pull the money out of your brokerage account when you made that taxable event, which was selling that stock, you created an event that is taxable, so you will be taxed. All right, we'll get a little more in depth into that later on. But yes, even if you keep the money in your brokerage account after you sell, you'll still be taxed on that. How much in taxes will I pay in my stock gains? We're going to talk about a little more further on, but this goes to short-term versus long-term investments, and we'll get into that a little bit later. What happens if I stole my stock for a loss? We're also going to get into this later on, but you will be able to claim that up to $3,000 a year as a loss. So it'll offset some of the gains that you made throughout the year. And how do I reflect my trading activity in my tax return? And this is done by when your brokerage gives you your 1099 Bravo, which they have to give to you by February 15th of 2021 is when you'll receive your 1099 Bravo from whatever brokerage accounts you have. So whether you have Robinhood, Webull, M1 Finance, TD Ameritrade, you'll be receiving these 1099 forms in there. And we'll take a look at what they look like. So when you receive that 1099 form, you could take it to your tax agent, or if you're doing it yourself, some of the platforms that you use for taxes will let you auto import. They give you a little number, so you'll be able to import all the combination of all the different tax brokerages you use. All that info will be input directly into that platform that you're using to upload your taxes. Is there any other questions you guys got, like basic questions that you guys think other people would want to know? Or maybe Jonathan, since you're like kind of new to this, is there any questions that you kind of feel like you have?
All right, so basically, I was going to mention this question. I didn't want to interrupt, but the question was going to be, since you mentioned Robinhood, because I have actual Robinhood.
Okay.
And I was wondering, because you mentioned M1 Finance to me before, so I was wondering, for the people who don't know, like me, which one, let's say I'm a first-time person, because right now I'm listening to you talk, and I want both of you to understand something. You guys know about this, but as I'm listening to you talk, even though I'm in the loop, I'm not really in tune as much as you guys, but as I'm listening to you, I already lost you from the first sentence. In all reality, as an adult to another adult, I'm being honest with you, and that's where I'm at, so you can understand from my perspective.
Okay.
But where I caught up was when you mentioned Robinhood. That's when I caught up with you, because I have that. So now my question to you is, what would you recommend for somebody starting up out of nowhere from scratch, their first app? Like where should they start, or what do you recommend if they want to start with an app? M1 Finance, Robinhood, or what else do you recommend?
That's a great question, man. It's not as easy as that. Is to each their own. Each of them have their pros and cons. regardless of which one you chose, I'm gonna give you the cookie cutter answer. Choose any of them. Just get started and choose. But if I had to give you information, especially since we're talking about taxes, I would advise them when they're first beginning to begin with a brokerage that's going to allow you to have a Roth IRA, which will allow you to have at least $6,000 a year be non-taxable whenever you're making those gains that you get. So whenever you have a Roth IRA, and I have a video, I'll post it in the comments below where I go into depth on what a Roth IRA is, and we'll talk about it a little bit further on. But every year you're allowed $6,000 that you can put into that account and do everything that you're doing on Robinhood, buy and sell stocks. And it doesn't matter how much you made that year, you won't be taxed on it. All right. But there is stipulations that go along with it. So that's the first advice I would give someone. Get with a brokerage that's going to allow you to have a Roth IRA. All right. Each of them are different. TD Ameritrade, they allow you to get into stocks that a lot of other these platforms don't have. They're called pink sheet stocks. So a company like TD Ameritrade, they'll allow you to get into these stocks from other countries. And there's stocks on TD Ameritrade that won't show up on M1 Finance and Webull, and they won't show up on Robinhood. So if you want access to like every single stock, I would start with like a platform like TD Ameritrade. For very new beginners, I would recommend M1 Finance because it's just straight to the point. You want to buy a stock, you know what your amount that you want to pay is, and you buy it. With like Webull, with TD Ameritrade, and with an app like Robinhood, you have to set like limits. Like this is how much I would pay for it. This is how much I would want to sell for it. And a lot of people end up like messing themselves up doing that because it gets like really more in depth. So I think M1 Finance is more, you want to buy a stock, go ahead, buy it. And that's the one I recommend to almost everybody that begins. They also offer a Roth IRA like we talked about. An IRA is an individual retirement account. And there's other stipulations that go along with that. And we could get into that a little bit later on. But does that answer your question?
It does answer my question.
All right, cool.
Go ahead. Do you mind if I make a quick recommendation?
Go ahead.
I would throw in there Charles Schwab. So I think they cater to a different end of the spectrum. They cater to older people, but it's very similar, right? So a lot of older people, they don't have the experience, and a lot of them, they're throwing their money in for the first time. They may have just retired.
Mm-hmm.
They may have inherited a lot of money. So they're trying to find places to put it. And Charles Schwab, right? I think markets to those folks as opposed to M1 that markets to younger people.
Yeah.
With that being said, I think just from my experience, they have walk-in places that you can actually go and sit in and talk. Brick and mortar. Thank you. They have brick and mortar places. You can ask any question. No question's a dumb question. Or you could pick up the phone. I think what makes Charles Schwab different from a lot of the other ones is their customer service. I think they do a lot of things they can improve upon, but I think their strength is customer service. So you could always call and say, "Hey, I don't understand this. Explain it," and they will. They'll find a rep in your state and they'll explain it to you.
Thank you very much for that.
Highly appreciate it.
All right, so that 1099 Bravo, I know you were kind of curious about what that is, but since you have Robinhood, they're going to send you something that looks like this. It's just a regular tax form. It's going to have information in here, input. It'll be your name, your information. You need to verify that your Social Security is correct when you receive it. All your information is correct, but they're going to give you this, and the information on here is the information that you're going to transfer onto whatever platform, or if you go to H&R Block, this is what you'll give them as part of your entire portfolio that you're giving them in order to fill out those taxes. Another page in there is going to look kind of like this, and it'll say, short term, long term, what your gains and losses were. So the description right here, whatever it is. So this could be the name of the stock, XYZ stock, the date you bought it, the date you sold it, the proceeds sales price, your cost base is what it was on it, and the adjustment of gains and losses. So it'll show here what if you gained money or if you lost money. So an example here is that they lost $1,500 in this example on here. All right. So what types of taxable events are you going to have? All right. So one of them is dividends. You're going to be taxed on dividends that you receive throughout the year. They're not going to be taxed on the spot. When you receive that 1099 Bravo form at the end of the year, you're going to receive that back, and it's going to have on there all the times you receive dividends. All right. So there's two types of dividends. There's qualified and there's non-qualified dividends. The big difference is that qualified dividends are going to be taxed at a lower tax bracket. For you, Jonathan, like you're not in the threshold yet, and I'll show it later, where you're even qualified for these, like for this amount. It's based on the amount that you make in a year, like in your regular job. All right. So if you make $12,000 in your regular job, these dividends would count on top of that. So non-qualified dividends do not qualify for the that smaller tax bracket. So the way it'll work is, let's say you receive $10 in non-qualified dividends, and you made that $12,000 a year that we talked about. You would be taxed $12,010 for that year. Does that make sense? If I'm going too fast, slow me down.
No, I'm with you.
All right. So that's the non-qualified. It means that all it means is that it doesn't qualify for the tax break. Qualified dividends means they qualify for the tax break. All right. What makes them qualified or non-qualified is a variety of different things. It could be the type of company that issued the dividend, or it could be the amount of time that you had the dividend, the date you bought the stock. And we could go more in depth in that. But there's other different things that'll make it qualified or non-qualified. Real estate investment trust or REITs, they're going to be taxed at a 20% maximum tax rate. Plus, you're going to get a 3.8 surtax on top of that. Real estate investment trusts, they pay a dividend, but they consider it a different type of dividend. Real estate companies, they have to give at least 90% of their profits in dividends. If not, it causes a big tax issue for them. So whenever you have a REIT, they're usually going to pay a very big dividend because they have to pay 90% of their profits in dividends. The next one is international. So if you have a stock from another company, and if you were here a few weeks ago, one of the stocks, my stock of the week was Ahold Delhaize. They're an international company that pays a dividend. When you receive that company's dividend in your brokerage account, it's already going to come taxed. So you don't have to claim this on your tax at the end of the year with the United States IRS. It's already been, when it falls into your account, it's already been taxed by that country. All right. All right. The next is capital gains. So you have short-term capital gains and long-term capital gains. So short-term capital gains is simply a stock that you've held for less than a year. And there's other different stipulations, like if you held it for a month or held it for 2 months. But if you've held a stock for over 1 year, you're going to be taxed capital gains for long term, which is a smaller amount of taxes that you'll be taxed. So short-term capital gains is like those day traders, or if you just bought a stock and then you saw it reach a certain price and you're like, oh, I got to make that money. So you sold it. You're going to be taxed at your regular income tax bracket. So if your regular income tax bracket is 35% a year, your short-term tax on that short-term gain that you made is going to be taxed at your regular tax bracket. Long-term tax bracket is different, and I'll show you that in a second. So this is paying taxes on short-term capital gains, and this is just the tax rates right here. So as under prior law, the Tax Cuts and Jobs Act taxes short-term capital gains recognized by individual taxpayers at the regular ordinary income tax rates for 2018. The ordinary income rates and brackets are as follows. The brackets really haven't changed in the last few years. The money has fluctuated just slightly higher for the brackets. So this is just what you should plan on paying depending on how much money you make a year. So for you, Jonathan, since you're single, you got to look at this bar right here, and you got to see how much you make a year. And this will show you on the left-hand side how much you should expect to pay on your taxes for depending on how much you make a year. Do you need me to elaborate, or you got it?
You just elaborated in exact detail. I'm here with you.
So I think this is where you fall. You fall in the 0 to 9,525. Am I right or wrong?
I would say you're right.
All right. So you fall in this area right here. So if you bought a stock and you kept it for less than a year, you would pay 10% on whatever gains you made on that stock. So I'll give you an example, man. Let's say you bought Microsoft company, right?
I got it though. I get it. If I buy Microsoft for 100, I'll pay 110.
No. I'm gonna show you. So you bought Microsoft for $10,000 in Microsoft, right? It got to 40,000, and you're like, oh, I want to get my profit. So you sold everything you bought. So your initial investment was 10,000, and you pulled out 40,000, right? You're only going to get taxed. 30. You're only going to get taxed on the 30,000 profit. You're not going to get taxed on the 40,000 because that initial investment doesn't count. You hear me?
Yeah.
So you're only going to get taxed on the 30% tax bracket, the 30% that you made profit, and you would get taxed 10% since you're single and you fall under this bracket right here. All right. So the difference is now for long term. All right. So if you held the stock for over a year and you made under less than 40,000, you're not paying anything. You're paying 0% on that profit on those long-term capital gains you made. If you make more than 40,000, we're paying 15%. If you make over 440,000, you're paying 20% on those long-term capital gains. So it really.
I ask you a question though.
Yes.
Pardon the interruption. When you say long-term capital gains, subconsciously I'm taking away the word capital and I'm just saying long-term gains or short-term gains. Capital just means money, right?
Capital is just a word that they put on there for the government. So yes, it's just gains. Whatever gains you made, they just called it capital because it was capital's money. You know.
Yeah.
Well, go ahead, brother.
The key takeaway, if you didn't catch anything, key takeaway is short term is under a year, long term is over a year. You be paying way more taxes if you buy and sell quickly. You pay way more taxes than you do if you hold something for over a year.
If I gained the 30,000.
Yeah, so if you gained 30,000 in 1 month and you sold it, you would get charged higher than if you made 40,000 and you sold it at the year mark. So if you held on to it for a whole year.
If you hold on to it for a whole year.
So basically the government just wants you to like hold it, like be a long-term investor. They don't want you like in and out, investing in and out, pulling your money in, put it out, pull it in, put it out. Like they want you keeping your money in the market for long periods of time. Does that make sense?
All right. It makes perfect sense.
All right.
Can I say one thing?
Go ahead, man.
Because I've never been on this before, so I want you guys to understand me and the people watching, you know, so I want everybody to understand. So I'm in New York right now, so I understand that in New York, I have an advantage because I'm, like say for example, somebody who lives in California, I'll be up before them. The stock is over here. You know, they gotta wake up at 5 in the morning over there to be at the same time when the stock market is open here. So I love that. So that intrigued me to even start getting into this. So I've done my research. I sometimes I forget the guy's name, but there's some guy who's like the most successful guy that he goes to eat McDonald's every day. I've seen like interviews about. I mean,
Warren Buffett.
Warren Buffett, that he drives the same car, the same ghetto car.
Yeah.
He's humble. He's humble as fuck. I love that guy. Like I love him. Like
that's a good person to follow, man.
So that's the thing. So I know that life is a learning experience. So in order to everything is a craft waiting to be mastered. So basically, in order for me to become the best, like when I write my music, I study the greatest that do it. You know, if I wanted to be basketball, I'll study Michael Jordan, the greats. You know, so I started studying Warren Buffett because he's the great. You know, he's like Drake when it comes to that. So I'm like, you know what? I'm gonna start doing my research on him. So I started seeing what he does. I've seen like a 2-hour interview where he talks about all his investments and how he takes chances and he's not afraid. Like fear is what holds people back from becoming successful, he said.
Yeah.
So that's one
let
thing I
me
learned.
Go
let me
ahead,
say
man.
this real quick.
What's up, bro?
I life is not long enough for us to master all crafts in life. But what you can do is know enough to ask the right questions to take to that professional, right? I think it's crazy if you expect LeBron to play basketball, manage his investments, become a movie star, producer. It's too many things. But what he can do is know just a little bit outside of his craft to take it to that professional. And that way he can seek the proper guidance and he can know who to trust and who knows just enough, who knows enough of what they're talking about so he can trust them. So that's you don't have to master the craft if that's not your love, but just know enough.
Okay,
All
yeah, because
facts.
he when I started watching this is gonna take like 1 minute, but when I started watching the Warren Buffett thing, it motivated me because I wanted to be like that, you know. I still want to, but my point is, I say that to say this, that I started seeing, like I said, I have to study him, so I started seeing what he likes to invest in and things like that. So he says I invest in, it's getting to my question. So he said that he likes to invest in, and he would advocate investing in things like Coca-Cola, things that are winners that you know is gonna
Yeah.
win. What do you think about that? Do
I
you
think
agree with that, or what do you think about that? Because I was about to go into that world, like where I would just invest in those things because he said that. Am I wrong, or what would you tell somebody with that mindset?
it's hard to say he's wrong when he's proven success. You know, his the method he used made him a billionaire. You know, created a path, he followed it, and he made it. And these investments that he invested in have paid out for him very well. You know what I mean? So I'm not going to take anything away from him. All I'll say is that depending on what your age is, should determine what your risk level is. So you being very young, I would say, man, that at your age, you should take more risk. You should be like your 20s, like your early 20s should be like where you're taking the most risk. As you get on later in life, that's when you want to take money out of risk assets and put it more into safe havens or things that are closer to safe havens. And you want to transition your portfolio to set you up for success, because you don't want to be that guy that's 50 and you're right there. You can see retirement out the door, but you're still investing in all these risk assets. And by the time you hit like 65, your account is at like, you know, negative, or it's not where you wanted it to be. So like in order to make the most money, you have to take the most risk. It's kind of sad, like if you really talk about, but that's the way it is. And you're muted.
I have one question. You hear me?
Yeah, go ahead.
And I'm sorry, but I think this is the best question ever.
Go ahead, man.
All right, so basically, because I'm building off what he said. Like it's all about the question. You know what I mean? So I'm thinking about the best question possible. Like what you're talking, I'm trying to like. What would you tell somebody? Let's say, for example, I'm gonna give you. Let's say, for example, somebody got 100,000, right? I'm gonna say you. Let's say you have 100,000, because you're talking. You can only intelligently speak for yourself. So let's say you have $100,000. How much would you invest out of the $100,000?
All right, great
So I
question.
can
Before
know.
I get into that, I'm gonna say for everybody watching, I am not your financial advisor. None of us here are your financial advisor. So anything you hear on here is just used for educational purposes and entertainment. That's why I got Jonathan on here now, so we can make he's kind of entertaining just to look at. But to answer his question is to me personally, so it's not going to apply to everybody else. So his first question was sort of, let me see if I got this right. If somebody came to me with $100,000, how would I tell them to invest that money?
Yes, it goes for. It's not just. It goes for. It's an
Yes.
open thing.
Yeah. So again, the first thing I would ask that person is, what's your investment time horizon? So how long do they plan to have that money in whatever they're going to invest in? If they give me a time window of like 2 years, like a very small window, they plan to like, so then I'll ask them, what is your goal? Is your goal to double your money? Or is your goal to just save your money? Because we talked about this before, you and me, there's something called inflation, where every year the value of the dollar goes less. So do you want to put your money into something that you're going to protect your dollar or whatever currency you have from diminishing due to inflation? So whenever they answered that, that's the way I would guide them. So if they wanted more of a safe haven, I would put them into something like a bond, municipal bonds that have a rate that is higher than inflation, or I would direct them to something like gold or silver or some sort of precious metal, because those are something that's an asset that's supposed to maintain the value of the dollar throughout whatever recession is. So the value of your currency will stay whole. If they have a long-term horizon, that's when I'll maximize their entire 100,000. The first thing I would do is put 30% aside, which would be 30,000, and put that into either cash or some sort of liquid asset. So whether it be cryptocurrency or cash, a lot of these big hedge funds now are taking the cash that they have on the side and converting that into cryptocurrency. All right.
I was just about to mention cryptocurrency.
Yeah. So then after that, we would construct them a portfolio based on whatever their view is. Like if they want to double their money, they want to, whatever it is, because how the length of their investment horizon is going to determine how much risk we're going to put in there. And when I say risk, a company like Coca-Cola, their stock may drop, but it's not a risk. Like at the end of the day, people are going to drink Coca-Cola every single day. Their stock price might drop $10, but people are going to drink Coca-Cola for the next 50 years. You know what I mean? And that's why Warren Buffett loves those companies, because they're not going anywhere. He knows he could put – the way they look at it is him and Peter Lynch, the way they look at it is if I put my money in this company and the stock market closed for 10 years, or I went into a coma and I woke up 10 years later, do I feel comfortable that my money would be safe? And the answer is yes, whenever they put their money into a company. Does that make sense?
Yes, I totally. You made it, that you summed up everything better that way for me. Like I had to visualize it. Like,
All right. So tax efficiency. Let's talk about, we already talked about how you're going to be taxed. Let's talk about how to be efficient when it comes to taxes. All right. So we already talked about it. Individual retirement accounts. If you're in the military, your TSP, or wherever you work, if in a corporation, if they have a 401k, maximize these utilities here, because a lot of these companies are going to pay you 5%. They're going to match at least 5% of the money that you put into the 401k. So it's free money. And the only issue that young people have with these is that the way they look at it is, I'm losing money in my bank account and I'm not going to be able to touch it for a long time. And they look at that as a negative. We need to flip our minds around where we see that as a positive, and we see that as like, I'm just putting it away and forget it. And then whenever I'm 65, I don't have to worry about anything ever again, because I'm going to have a pot of money that's sitting on the side waiting for me. Does that make sense?
it's like a CD account.
Not exactly, man. A CD account is like something that's short term. Even though it's a year, is a short term. IRAs are like or TSP or 401k. They're until like you're I think, what is it, 59 and a half or I think it's 59 and a half when you could pull that money out. I got to look at it again. But these are like whenever you're really old, you're going to pull money out of here. Does it make sense?
Yeah.
You got
Where's
anything
that noise
with this?
coming from?
The stove. You got anything from this, Matt? It looked like you had something to say. You good? All right. Municipal bonds. So these are, they call them munis. All right. So basically what a municipal bond is like if you're in New York, the streets in New York, they need to be fixed. They need to be fixed, and things need to be maintenance, right? So the way they pay for that is they create something called the municipal bond. So New York will have a bond that you can purchase for 10 years, 20 years, 30 years, and they're going to pay you a dividend. And their promise is that at the end of it, you're going to get your money back. So all you're doing is putting your money in there. They're going to give you the same amount of money you gave them back, but in the interim, they're going to give you a dividend every so often. Municipal bonds, those dividends that you receive from municipal bonds are tax-free. So that's why I put them in here, because they're municipal bonds, you're not going to be taxed on those. If you have a federal municipal bond, you won't be taxed at a federal level. If you have a state municipal bond, you're not going to be charged at a state level for that dividend that you receive. The next one is selling for a loss. So if you have this company that you like really have no faith that it's going to go back up to where you had it, and let's say you have 10,000 in it, you've lost already 5,000, and you don't think that it's going to go up anytime soon, and you see opportunities elsewhere, pull that money out, sell it, and then just claim $3,000 of those as a loss on your taxes, and it'll offset any of the gain that you made. So if you made $3,000 in gains, if you sell for a loss and it's up to $3,000, the government will look at it like you didn't make any money that year, and you won't be taxed on the $3,000 profit that you made, if that makes sense. I just recommend doing this if you were going to sell the stock anyway. Like if you feel like it's going to go down, I don't recommend doing this just to do it. But there is corporations and hedge funds that do this at the end of the year, usually around this time of the year, they're going to start selling in order to offset some of those gains that they made with tax losses. Holding the stock for over a year, like Matt mentioned. All right, so you hold that stock for over a year, it's going to be that long-term capital gain if you hold it for over a year. You got it, Jonathan?
Yeah, could I ask you one question?
Please.
These are just like real honest, genuine questions that I think about. And I never get to speak to you because it's the time difference like that about this. But like someone like me, for example, when I go to Robinhood, I have gained before, but I only gained 12 cents in a week or like 10 cents, but I gained 10 cents. It's a gain. 10 cents makes millions, yeah, but in time.
Mm-hmm.
But what if I want to make hundreds of dollars a day? That means I have to invest thousands of dollars a day, right?
Not necessarily, man. It all depends on how you do it. With Robinhood, again, the more money you want to make, the more risk you need to take. Like if you want to make faster money, but you also need to know that money that you're putting up in the market, like you can lose that. So
yeah, it's like blackjack.
Especially like if you're buying like Coca-Cola, even if that stock went to $1, you didn't lose anything. And Coca-Cola is never going to go to $1. So like that's why Warren Buffett said invest in companies like that. But to make the money you're talking about, you're either going to have to day trade, and we'll save that for another video, or options trading, and you could do both of those on Robinhood. But yeah, if you don't have 25,000 in your account, you won't be able to. You can only day trade 3 times a week on Robinhood. I think that's a thing. But yeah, man, those that fast money you want to make is going to take a lot of risk, and you could have made 20,000, and then you get stuck in that pattern, and then you could lose that whole 20,000. So you just got to be smart about it. But you got something, Matt?
Yeah, this is a question for Jonathan. So let's say in a month, right? I threw in $1 million in Nike. I caught the Jordan release. I made $100,000 in 1 month. But then I threw same thing. I threw $1 million in Sony because last year I knew the PS5 was coming out, and I made $100,000 in a little bit over a year, right? And I sell both of them. I sell the 100,000 profit in Nike, and I sell the 100,000 profit in Sony. One I did for a month. The Nike one I did for a month. The Sony I did a little bit over a year. Which one do I make more money in?
The one they did over a year.
Why?
Because you said if you do it over a year, they take less from you.
Okay, very, very good. So how much more? Rough estimate. How much more?
He said something about 10%.
So give or take, my numbers could be off, but give or take, I think after taxes with Sony, I'm walking away with maybe, so at 100K is getting taxed at 15%. I'm walking away with 85,000, give or take. With the Nike, I think that's gonna be taxed.
He froze. He meant to say
think
40. He froze. Yeah, he meant to say like 40%. So after that, you would be taxed instead of
Around what?
making,
What, George? Around like, so about six.
yeah, you would make about 60,000
See.
instead of 85,000 if you hold it over a year.
So the same profit margin, but because of the tax rate, one I made 60K, the other one I made 85K. And you talked about Warren Buffett. He it's like basketball. He knows the rules of the game. He knows when the ref is going to make certain calls, and part of playing the game is knowing the rules. And one of it is the tax efficiency rules.
All right. Next is tax loss harvesting. All right. Well, let's get into that. What is tax loss harvesting? All right. So tax loss harvesting is the selling of securities, which is stocks, at a loss to offset a capital gains tax liability. All right. I'll say it again. Tax loss harvesting is the selling of securities at a loss to offset a capital gains tax liability. All right. This strategy is typically employed to limit the recognition of short-term capital gains. Short-term capital gains are generally taxed at a higher federal income tax rate than long-term capital gains. So, is it worth it? Is tax loss harvesting worth it? Basically, all this means is that at your tax bracket, Jonathan, is not worth it because you're making less than that threshold to be taxed at 15%. You're being taxed 0%. So you taking a loss is not really offsetting anything for you. If you're in the 10% or 15% tax bracket, you pay 0% in capital gains taxes. So there's no reason to try to offset taxes on your gains by harvesting your losses. You'll pay no taxes on those gains regardless. So how does this apply to you? That's how it applies to you. Tax loss harvesting is not doesn't apply to you. This is just a picture of how to look at what it is. So this is just using a $25,000 tax loss to get a tax break. So you have two investments. All right. In investment A, you made 20,000 in capital gains. All right. So the potential you're going to owe on taxes at a 35% is 7,000. In investment B, so this is the same person. They have two investments. And the same year, they lost 25,000, a capital loss of 25,000. So the 7,000 here is going to offset that gain that they made. So they're not going to have to pay any capital gains tax this year at least from investment A. Then they can apply the other 3,000 as that capital gains loss that you're allowed to do $3,000 capital loss every year. And then you can apply the 2,000 to future gains. So if next year you make capital gains of 2,000, you can offset it with the losses just from this one investment. So your potential savings is $8,050 for your total potential of savings here. I think this is self-explanatory, Jonathan, but I don't let me know if you need me to explain this again.
I'm listening, bro. I'm with you.
Cool. All right. With all this said, with all this talk about tax loss harvesting, of course, the government, they can't let you just be squeaky clean. They need to do something, right? So they created something called the wash sale rule for taxes. The way this works is the wash sale rule prevents you from taking a loss on a security if you buy a substantially identical security for an option to buy or such security, or you buy the actual security. When I say security, I just mean stock. Or if you're doing cryptocurrency, I just mean that same cryptocurrency. So if you sold Bitcoin and within 30 days you bought Bitcoin again, you're gonna be in the wash sale rule. So you're still gonna have to pay short-term capital gains. Within 30 days before or after you sell the security that created the loss, you can recognize the loss only when you sell the replacement security. So this is how it works. I buy on May 1st, I buy Coca-Cola, right? And then I get halfway down through the month and I'm at a loss. So I get to the 15th of May and I sell Coca-Cola and I immediately buy Pepsi. I fall under this wash sale rule. So I'm going to have to pay short-term capital gains. All right. So what can we do to not fall under the wash sale rule? We could sell the security and immediately buy shares of a security of a different company in the same industry, or shares in a mutual fund that holds securities much like the ones you sold. Sell the security and wait 31 days to repurchase the same security. So let's say what this is saying is if I bought Coca-Cola and I waited 15 days, I sold it, and then I waited 5 days and I bought Coca-Cola again, I like those losses I made are not going to be considered capital loss, right? So if I do the same thing, I buy Coca-Cola on May 1st, on the 15th I sell, and on the 20th I buy Pepsi, like they're going to consider that short-term capital. They're going to consider it capital loss. All right. So that's what it's telling you to do here. Don't buy the same security over and over again. All right. They don't want people because what happens is that some people will do this in December. Before this rule came about, December hedge funds would sell Coca-Cola, and then January they would buy it again. So they would, the next year when they file taxes, they would say that, during the year of 2020, we sold for a loss on Coca-Cola, but then they buy it again the very next year in 2021. And they just do that every December, so they created this rule because of that. This is just what it looks like, a picture of it. I know you're big on pictures, but right here, you sell or trade a security loss. You wait less than 30 days and you purchase a substantially identical stock or security. The loss cannot be claimed. Does that make sense?
Yeah.
Pretty self-explanatory, man. One thing I will add is that whenever you have cryptocurrency, whenever it comes for 2021, with cryptocurrency, there's going to be something on there that's going to ask you, did you buy any? Did you use any? Were you giving any cryptocurrency throughout the year? And you're going to have to answer yes. If you don't, it will be considered fraud. So even if you didn't sell it or you didn't do anything, there's going to be something on the tax form this year that's going to ask you if you were even given it, if you used it at all to purchase anything, if you purchased and held some, if you made profit off of some. So there'll be a certain thing that you'll be asked this year for that.
And if you say no, it's fraud. But if you say yes, that's actual fraud.
No, if you
but you're lying.
If you bought it and you don't say you did, that's fraud. If you never had it, then obviously you're gonna say no.
Does Coinbase give you their version of a 1099 or 1098?
Coinbase does not. So for that, you're gonna have to. But I use eToro, and eToro will at the end of the year they're gonna give me a 1099 Bravo for the securities that I've held. That's where I hold my crypto. I hold it in eToro. But from last year, I know they didn't. This year they may.
And my next question is, how do you feel about this reporting of the cryptos on your taxes? What does that tell you for the future?
To answer your first question, does Coinbase provide 1099 Ks? I guess Ks for cryptocurrency. As of the 2020 tax year, we will not be issuing a Form 1099-K for trades in the Coinbase exchange. So as far as your other question, what do I think it means for future? I think they're seeing it become a more relevant taxable event. And the same thing they're going to do with, marijuana, they're going to be doing that with cryptocurrency. Like they want to know how we're using it, when we're using it, why we're using it. So whenever they create a tax law around it, they'll be able to like use verbiage in there that captures what we're actually using it for. Because they're seeing it being used more prevalently, especially with like companies that, PayPal, Square. These companies are purchasing big amounts of Bitcoin and Ethereum, and they're allowing people to trade them on their exchange and use them as currency. So the way it works with PayPal, uh, whenever you pay, like, so somebody will deliver pizza to your house, right? If you have Bitcoin in your account, you can pay them on the PayPal app with Bitcoin, but PayPal is going to grab that Bitcoin, they're going to pull it out, they're going to immediately turn it into the local currency, and they're going to give that pizza delivery man the local currency. So that's the way it's currently working right now with PayPal. So it's not like I'm giving the pizza guy Bitcoin. I'm giving the pizza delivery guy dollars, but I'm giving Bitcoin from my wallet, and PayPal is taking that and exchanging it for the local currency and giving the pizza man the local currency. Does that answer your question, Matt? Or I'm sure you had a point on it as well.
Fine. No, you answered my question. Definitely, they're starting to integrate cryptocurrencies and the usage of them. But I think the point I was trying to make is that I see a lot more regulation coming down. I think this is just my prediction. I think cryptos could potentially be the victims of their own success. So the larger they grow, the more eyes and regulations will come in. I mean,
Yeah.
that's just my take.
As you can see, man, the government's starting to realize like they need money. Like they need money and they need to find it from different places. They can't just continue to tax us, 60%, 70%. That's where we're headed. They're going to charge us like 70% of our tax. So where are they going to tax us? And it's moving into places such as gonna like 5 new states this year made marijuana like recreational use legal. Why do they do that? Is because those states can now tax and they can make money off of things that people were doing anyway. Does that make sense? So they want to do the same thing with cryptocurrency. Okay, you want to use Bitcoin, you want to use Ethereum. I'm going to get mine. So just let me know how I can do that. And I'll go ahead, man.
I think you're 100% right, but I would just make the distinction on a state level. They're looking to tax anything. On a federal level, they're gonna do their favorite trick. What's their favorite trick? That's it.
Print money, print money. Jonathan, man, it's good having you on here, man. Having your perspective on here. Like, I think I get so used to talking to people that know a little bit. Like, I start talking like that, but having you on here shows, like, what the average person out there, or the person that has below average knowledge, how they're receiving what I'm trying to say. So I like that because you slow me down and you allow me to put things into more perspective. So I thank you for that. Any last questions, man, before I let you go? I know it's like 6:30 in the morning over there.
It doesn't matter. I come from the city that never sleeps, brother. So listen to what I'm gonna tell you though. I'm gonna tell you this much. I know that in Europe, there's I don't know if this I'm assuming with this one, but I know in Europe for sure there's like I don't know if it's a country or a continent or whatever, so it's like a little city or something that Nipsey Hussle was there. You heard?
Yeah.
And he's talking about it, like he's talking about cryptocurrency. And he's telling everybody how it's the future and how he's in this place where it's like just visualize like a whole country that's all about cryptocurrency.
Yeah.
So right now, due to the coronavirus, you have to understand this whole thing is it's a setup, but it has something to do with money at the end of it all. And if you think about it, in reality, like in perpetual reality, the dollar, the actual piece of paper, the dollar, like gold, like you said before, liquid assets and gold and all that, right? So that's all. When you take it to, when you go sell that, they weigh it. They put it on a scale, right? They weigh it. But when you consider that, and when you're talking about it in the sense of actual money, the dollar bill is a gram on the scale. The $100 bill is a gram, and the $5 bill is a gram, and they're all the same piece of paper. You just have different color ink on it, different numbers, but it's the same thing.
That
So
mentality you
basically,
have is why Matt on here, he's like transitioned a lot of his paper asset into physical silver and gold. Like that's what he put his money into, because he sees the deflation or inflation of the dollar, whichever way we go, and he's transitioned a lot of his money into precious metals because they're supposed to maintain the value throughout time.
yes, if he has pure gold, then it's gonna never decrease.
That's what he's got. I mean, that's all we want to purchase. You know what I mean?
Yeah.
But yeah,
No,
man.
but sometimes people purchase gold and it has like 70-30, like 70% gold, and then they have like some like rose, like for example, rose gold is never 100% gold. Rose gold has like copper in it,
Yeah.
That's what I'm saying, like those type of examples.
Yeah. You got any more questions before we get off?
He's speaking the truth. He's speaking the truth.
He is, man.
Hey, he dropping knowledge.
That's
But
good,
and that's my thing with cryptos. That I think it's an all or nothing game. Either they're gonna be uber successful, or it'll be no different from NBA 2K19, where it's like, all right, it's not relevant. We moved on to 21, or we moved on to 22. We moved on to the newest and latest and greatest. So it's an all or nothing game.
I appreciate y'all. All right, so for everybody watching, we're up to 29 subscribers. I'm like in awe. I didn't think we'd get that much this quickly, but we're almost at 30 subscribers. So thank you. Let's keep the movement going. Now I'm setting goals. I'm trying to reach 50 by January 30th. So let's get us there. Let's get to 50 subscribers. Besides that, thank you for watching. Don't forget to like, comment, subscribe. My name is George. That's Jonathan. That's Matt. And until next time.